Hi everyone, welcome. I'm Ross, the chairman of the Hive Business Group. Here today to actually kind of partially related to the recent autumn budget 2024, specifically talk about capital gains tax. So very pleased to welcome my tax director colleague today, Simon.
Thanks, Ross.
Yeah, fab. Thank you. So yeah, we're going to really focus on capital gains tax or CGT, just kind of explore that area, and some of the kind of the recent topical kind of updates. So thanks, Simon. Let's just start with, what is capital gains tax?
Yeah, I think it's really useful to start with the basics on this. Uh, it kind of broadly, a few different types of tax we have in the UK. Income tax we're all familiar with. It's what you pay and what you earn. Capital gains tax is tax you pay on assets you sell. So that might be something like property. It might be businesses. It might be kind of your shares in your company. But it's those kind of long-term assets. Capital gains tax is due on those. CGT for short.
Fantastic. Thank you. So yeah, both individuals, both
Yeah.
companies pay it. Is that kind of a good summary of who might pay it? The individuals and companies?
Yeah, individuals pay capital gains tax, companies pay capital gains tax. We don't come across it quite so often. Our client base won't have heard quite so much about this, but trusts pay it. What doesn't pay it is a SIP. So if you've got assets in a pension, self-invested pension, they don't pay CGT.
Fair. Um, Great. So, and it's the seller that pays it. Is that correct?
Capital gains tax is paid by the seller, although I'd be really careful of using the word seller. It's probably the person who's disposing of the asset, because there can actually be situations where there's capital gains tax to pay, even if something's not actually been sold. So if it's been given away, the default position we have in capital gains tax law is that any transfer of an asset happens at its market value. There are circumstances where we can override that, but the default is market value. So if you give me a rental property that you own, you have to pay capital gains tax as though it was purchased by me for what it's worth, even if
Well,
I
okay.
haven't
So it
given it
feels like
away.
that's the first kind of landmine we've got to be careful of. So it's not whether you sell something, it's not even necessarily whether you receive cash for it, it's if you dispose of it. And
Yeah.
there's I mean, probably quite cynically, I'm looking at it and thinking, well, HMRC just want their little slice of tax whenever something like this happens. So even if you try and circumvent it, they're still going to take their slice. Is that fair?
Yeah, absolutely. There are certain kind of reliefs available, which we'll come on to in a bit, that can help the situation if it's what we call a business asset. But yeah, the default is in all of tax. If there's a way they think it can be taxed, then there might well be some tax due on it.
Okay, so kind of giving properties away to your family, it's really going to cause you a bit of a
Yeah.
pickle and a bother and some penalties and all those kind of nasty things. Great. How does that kind of dovetail with the recent autumn budget then? Because I know a lot of people were kind of looking at it, very definitely bracing for, massive kind of 39%
Yeah.
taxes, align it with income tax, that kind of narrative, which, with hindsight, we now look at it and say, well, they were kind of, they were taking us to the extreme, so it wouldn't sound quite so bad with what they ultimately imposed. But what happened?
So there's kind of two or three main things that happened with capital gains tax. I suppose the underlying principle is that none of the rules about how capital gains are calculated or the reliefs that are available, none of that has changed. The only things that have changed are the rates that the tax is payable at. So capital gains tax is now payable at 18% if it falls within your basic rate band, up to kind of 50K of income, but that factors in other income you might have as well, like dividends or
Yeah.
salary. And the higher rate of capital gains tax is now 24%. So those are up from 10 and 20. It's now 18
Yeah,
and
okay.
24.
I think realistically, most of our viewers, most people that are selling things will have some other income. So, kind of practically, the default rate's gone up from 20% to 24%. I think that's what you're saying, isn't it?
Yeah, definitely. Been a few more changes as well to what a lot of you will know as entrepreneurs relief. It's actually now called business asset disposal relief and has been for a couple of years. That meant that you could have £1 million of capital gains on which you pay 10%. Um, from April, that's now going to be 14%, and from April next year, it's going to match the basic rate, tax rate, so 18%. So entrepreneurs relief exists, it still exists. It's almost doubling over the next couple of years, so the tax rate is doubling from, well, 10
There's
to
a little bit of an incentive there just to kind of capture it if you're selling a business, because you're not going to pay 24%, you're going to pay 18%.
yeah.
Cool, okay. Cool. Well, I mean, like I said, I think they don't think they did a bad job, bracing us for a horrible increase. So weirdly, it kind of feels not as painful as it could have been. But are there any other bits of kind of good news surrounding capital gains tax?
Well, I think the really good news is that actually we know what the rates are. We know what the change has been, and it's mapped out for a couple of years now. So we've got plenty of opportunity to make sure we harness those lower rates whilst they still exist.
Cool. Okay. Mentioned earlier, there's some kind of potential reliefs against it. We've gone through kind of business asset disposal relief. What some other ones that people might want to be alert to?
So we've referred also to the the overriding principle that things happen at market rate. If there's business assets being disposed of, so that's shares in a business that is your own business, owner managed business, or business goodwill, for example, or commercial property, we've got something that we refer to as gift relief, which is where both parties, the buyer and the seller, can agree that actually this is not happening at market rate, and therefore the tax can be based on the price that's agreed between the two. That's what we call a deferral relief. So the new owner is going to end up with a bigger tax bill later down the line because of it. We've also got similar deferral reliefs to do with reinvesting funds. So if you sell an asset, might have a capital gain on it, but you reinvest that money into another asset, which is within the world of capital gains tax, the tax due can be again rolled over, deferred until that second asset is sold. A bit of clever planning around that can mean that actually, depending on what your future plans are, capital gains tax never really gets paid. It does have relatively narrow application.
And the first one you kind of mentioned there, a gift relief. Do you use that one often, or?
It's very useful in business and corporations. So you may have a situation where you wish to incorporate your business. We do a lot of that with dentists. There's still loads of tax to be saved from incorporating.
Even if you've got an NHS contract?
Even if you've got an NHS contract, even if you've got existing bank debt, there's almost always a way we can make that work and save you tax. But the downside of an incorporation is you've suddenly got £1 million business that you only paid a couple of £100,000 for 10 years ago. You've got a huge capital gain. Maybe we can harness gift relief to avoid that gain at the point of incorporation. It means there's no tax when you do incorporate, just loads of tax to be saved afterwards.
Yeah, cracking. Okay. Well, there was one that I wanted to kind of ask you about because I think in the right circumstances, and I think this is a thing that we're finding with our client set quite a lot. The right thing for one person can be the wrong thing for the other. But the one I really was bracing myself for was a relief which allows kind of a tax-free sale of your business. And I don't even think a lot of kind of practice owners necessarily even realize that a tax-free situation is possible out there. Is that what your experience might be, or?
It's definitely still the case. It is still available. And again, it very much is, well, it might be right for you, it might be wrong for me. Just because it is right for one person, it might not be right for another. But there is absolutely a way that shares in a company could be sold completely tax-free. There's compromises to make. There's always compromises to make in tax. There's pros and cons with everything. It is often a case of choose your compromise, get the upside that comes with it. But there can be a set of circumstances where companies can be sold tax-free. That still exists. That's remained unchanged. And to the best of my knowledge, in the corporate tax roadmap that was also announced alongside the budget, that relief is still set to stay. So
feels kind of quite good news in a way, doesn't it? Like with everything else that being pinched, that still is as an option for some people. Like I say, it's quite intoxicating to hear something that could be tax free, and we might not choose it, but you know, how do you kind of go about helping clients with these kind of options then? Because, like I say, tax free sounds quite intoxicating. What would be the way to kind of find the best solution?
Yeah, well, the first thing I would say is, get in touch. We can speak to you. We'd love to speak to you about what your exit plans might be and what that might look like. We've got a kind of tried and tested roadmap of how we kind of deploy our tax advice through the fact find, design, and implement process. So we need to know everything we need to know. And actually, when we first speak to you, we might not even know everything we need to know. So we have to go through the detailed fact find so that we know where we're starting and importantly, where we're going. What are your objectives? Because we're here to achieve your objectives, not ours. So where we're starting, where we're going, we then have to, what we describe as design the optimum way to get there. So like we've probably alluded to already, there can be more than one way to achieve an objective in tax. So we fact find, we design, and then we sit down with you and we work out which of these is the best for you. That might mean tax-free exit. That might mean actually it's better to pay the tax. Now that sounds daft if you don't know tax, I suppose, but there are situations where that tax-free exit will not be what you want because of
It's
what comes
usually the
afterwards.
concept being pay a little bit of tax, so you save significantly more down the line, or
Yeah,
some version
a
of that.
lot of it is about actually what do you plan to do next? That will dictate a lot of what your exit taxes should look like.
Yeah. So it does feel like planning gets the best outcome here. Then it's what do you kind of consider planning is in that sense? If someone's selling their business in January, let's say, or 2 or 3 months away, what
Uh,
happens?
if we're that close to an exit, then there's not a lot we can do about what's going to happen. The best thing we can do is make sure it does qualify for the right reliefs if there's any available, and if in particular that's entrepreneurs relief, actually let's make sure this finishes by April so that that's still 10% for you. If your exit is a few years down the road, then we've got way more opportunity to reconfigure things for you and grab some tax savings, the right tax savings for you. A lot of the tax planning that we might do needs at least 2 years to be effective. It's just the way the laws are written. So I would always say it's never too early to be thinking about your exit. It might even need to start 10 years before you plan to stop. In extreme examples where sale might be to a corporate that want a 4-year tie-in.
Yeah, fair point.
Yeah, so never too soon to be thinking about what this is going to look like.
Real. Well, I think that's been a bit of a whistle-stop tour, and we've actually still covered a lot of ground in there as well. Any kind of final points that you think is relevant for our viewers and for our practice owners and our potential future practice owners?
Yeah, definitely. There are still a few things that can be done. Very simple things that can help improve your tax situation. So entrepreneurs relief isn't going to be as nice as it was, but if there's a spouse, for example, who becomes a shareholder, there's twice as much profits available at 18% instead of 24. You wouldn't waste a 6% saving if it's available to you. So bringing your spouse in can be useful. There's still lots of opportunities around incorporation, creating director loans. Actually, we can create director loans, i.e. access to tax-free cash in the future for companies that have already incorporated in certain circumstances, but it's probably the topic for another video. Get in touch if you do want to know more there. There's opportunity for kind of company restructuring as well. And obviously, while the rates are what they are, there's other assets that can be liquidated kind of more easily. So crypto, for example, crypto is within capital gains tax. So is things like maybe gold and those kinds of assets, which are much more easy to dispose of.
Oh, wow. So hang on, let me just check then. So, we've spoken a lot about kind of specific business assets, but you're planning for other kind of more diverse kind of assets as well for your clients. Is that right?
Yeah, so it's not just business assets. I know that has been a big focus of what we're talking about, but it's anything other than the plant and machinery and the equipment you run your business with is probably subject to capital gains tax.
So like
So
crypto, what we
crypto,
mentioned there, sort of crypto and gold,
yeah,
any
crypto,
other kind of in,
gold, some artwork is within capital gains tax. Uh, my mind's gone blank. The list is not endless.
yeah.
But you get the idea. It's investment assets.
Okay, cracking, interesting stuff there. So plenty of planning to be done then, I suppose.
Yeah. Yeah, absolutely. Happy to have any kind of conversation with anyone who is worried about what a capital gains tax bill might be now or in the future. Um, Drop us a line.
Cracking. Thank you very much. So I really appreciate it.
Thanks, Ross.